Welcome to the November 14th, 2016 edition of On the Call, the service of Zacks Professional Services. If you're new to our calls, this is a live conference call featuring Zacks strategists providing their analysis of the latest issues and trends affecting investors, including, but not limited to, current issues and trends affecting the market, the economy, both globally and here in the United States. Today, our research director, Sheraz Mian, and Tim Nyland, Managing Director of Zacks Institutional Services Division, will be our panelists. Sheraz is going to be putting the Q3 earnings season into perspective, as well as previewing what he sees for earnings going forward. And Tim is going to share his thoughts on what this current earnings season tells us about the market for Q4, and maybe we can even get both of their early impressions on this presidential election's impact on their respective areas of focus, if we ask nicely and time allows. So Sheraz, let's begin with you. You wrote recently that this Q3 earnings season marks an inflection point. Are you just referring to the end of earnings recession, or is there something more to it than that?
Yeah, it's both, Terry. There is the growth component to it, and I'll come back to it in a little bit. Let me go straight into the earnings scorecard to bring folks up to speed as to where we stand and how it's different in terms of performance from what we have become used to seeing in the recent past. So what you are seeing is the Q3 earnings scorecard. We have now results from 455 S&P 500 members already out. 91.2% of the index's total membership. Total earnings for these S&P 500 members are up 3.9%. Total revenues are up 2.7%. 72.8% are beating EPS estimates, and 55.3% are beating revenue estimates. The second last column here, which shows blended beat percentage, is basically looking at the aggregate picture for the S&P 500 members who beat both EPS and revenue estimates, and that you could see is 45.6%. Overall, pretty positive and encouraging picture from Q3. In the following slide, we'll put the Q3 results in a historical context. As you could see, these two comparison charts just put the Q3 results in a broader historical context. What we have done is the left-hand chart compares the Q3 growth rates for earnings and revenue, and the right-hand side chart compares the surprises for Q3 and compares them to what we saw in previous quarters. So let's take a quick look at the left-hand chart, which is labeled Q3 growth rates compared. And as you could see, the 3.9% earnings growth, the green bar, and 2.7% revenue growth, the orange bar for Q3, is notably better than what we have seen in the previous quarter, which was the second quarter of 2016, or the four-quarter average growth rate for earnings and revenue. And we also provide here for comparison the 12th quarter average. So you can see that that earnings and revenue growth in Q3 is the best that we have seen over the last 12 quarters. That's 3 years worth of data. On the surprises front, the right-hand side chart, you could see that we are tracking a little bit above historical levels, not in a big way, but positive surprises are nevertheless a little bit more numerous than what we have been seeing. And just one small point to I want folks to note that the comparisons we are doing here is for the 455 S&P 500 members that have reported results already. So when we are looking at the growth rate in Q3, we are looking at the growth rate for the same 455 index members across these historical periods as well. So let's go to the next slide. Here I'm putting the blended beat percentage, and I briefly touched on this when we were looking at the scorecard table. What it basically shows is that of the 455 index members that have reported results in the third quarter, 45.6% have beaten both EPS and revenue estimates. And as you could see, a comparison of what these same companies had done in the previous quarter or the 4 or 12 quarter averages, you could see that it's an improvement over historical performance. Let's go to the next slide. So we know that energy has been a drag on the aggregate growth picture for a while. That's the case in Q3 as well. Total earnings for the energy sector were down more than 60% year over year. So the left-hand chart, which we showed earlier as well, presents the aggregate growth picture as is, meaning it includes the drag from the energy sector. The right-hand chart looks at the aggregate growth picture on an ex-energy basis, and you could see the Q3 growth rate becomes a lot more respectable. 7.5% earnings growth on 4.5% revenue growth in Q3, and as is the case on the left-hand side, with energy included, the ex-energy picture is also notably better than historical periods. Just a small note here, the Q3 energy performance, the 60% drag decline in earnings for the sector is the last quarter when we have tough comparisons for energy. The comparisons picture starts improving from Q4 onwards, and we will not have to deal with this energy drag in the coming quarters, unless of course we have a big sell-off in energy. So this slide titled the blended Q3 summary is basically combining the actual results from the 455 index members with estimates from the still to come 45 S&P 500 members. A bunch of those are retailers. We have a number of those reporting this week: Walmart, Target, Home Depot, Lowe's, and a few from other sectors. But at the bottom, the third from the bottom row, titled S&P 500, gives you the aggregate picture. So the Q3 earnings growth is on track to be 3.4%, and the Q3 revenue growth is on track to be 1.5%. And this compares to a decline of 2.8% in the previous quarter for earnings, and essentially flat revenues in the previous quarter, which was the second quarter of 2016. So positive earnings growth for the first time after 5 back-to-back. Yeah, we can go to the next slide, which is titled "Earnings Recession Ends." And this is what Terry was referring to at the top of the segment. This is the first positive earnings growth for the index in 6 quarters. We had 5 back-to-back quarters of earnings declines. Ahead of the start of the Q3 earnings season, The expectation was that we will get positive earnings growth in Q4 and that Q3 will remain modestly in negative territory, about 1% decline or around about in that range. So it's encouraging to see that despite the energy drag, we got this positive growth performance in Q3. So if we go to the next slide, this puts us the broader historical and present and then future outlook for earnings growth for the index. The orange bar is Q3, which is on track to be 3.4%. For the current period, the fourth quarter of 2016, earnings growth are currently expected to be 3.3% in positive territory. And then we have a material ramp up in 2017 with double-digit earnings growth in the first quarter and some deceleration from that very high pace in Q2 and Q3 2017. So the inflection point reference that Terry made in the beginning is referring to this. At one level, we came out of earnings declines for the index, and at another level, the positive growth arrived ahead of schedule. It was expected to arrive in Q4. It actually came in Q3, and the expectation now is that this growth trajectory continues into the current and following quarters, giving us a favorable and positive earnings backdrop for the market. And out of this was happening even prior to the presidential election and the positive favorable sentiment in the stock market as a whole. So you could see from this chart that the earnings backdrop was turning positive for stocks for the first time after an extended period of subpar performance. Let's go to the next slide. And this looks at how estimates, earnings growth estimates for the current period for 2016 Q4 have been evolving in recent weeks, particularly since the start of this quarter. And as we mentioned earlier, earnings are expected to be up 3.2% in Q4. And you could see that at the end of September, towards the end of Q3 and the start of Q4, earnings growth was expected to be 5.5%. And this is a trend, this declining trend in estimates is something that we have lived with in this earnings cycle for the last 3 years or so. So the overall picture of negative estimate revisions is not unusual. What is unusual, however, that the magnitude and pace of negative revisions that we see here for Q4 is not as bad as we have been used to seeing over the past year and a half. In other words, the decline from Q4 growth from 5.5% here to 3.2% is negative, but it's not as negative as what we saw in Q1 16, in Q2 16, and throughout 2015. So not only has growth turned positive, the recession has ended, but the trend on the revisions front has also ever so slightly improved as well. So if we go to the next slide, we are basically stepping back from the quarterly picture for earnings and looking at earnings in an annual sense. And the orange bar here represents 2016. It's showing earnings at two levels. The left-hand scale is showing the total earnings, and on the right-hand side scale, we are showing the year-over-year growth rate. So the orange line going through the chart is the year-over-year growth, and we did extend it all the way to 2008 to show folks the extent of where we have come from in this earnings cycle after bottoming in 2009, in fact. So 2016 earnings as a whole will be below 2015, which itself was below 2014. So we have essentially been operating at a flat earnings backdrop for the past 2.5, 3 years, and as you could see in the shaded green bars towards the end, representing 2017 and 18, there's a very strong growth in 17 as well as 18. We'll have 2.5% decline in 16. A big part of that is the energy drag that we discussed earlier in the context of Q3 results. And the energy drag ends, as we mentioned earlier, in Q3, and from Q4 onwards, it's positive comparisons. So we have none of the energy issues in 17 and 18. That's a positive contributor to those years, but that's not the only positive contributor. Growth is expected to resume in a meaningful way from a number of other major sectors too. So here we are showing 12.1% earnings growth in 17, and then followed by 11.5% growth in 18. Just to put the numbers in context, these are billions of dollars. So what it means is $1,177 billion, or $1.177 trillion in earnings for the S&P 500 in 2017. Now, $1 trillion earnings is a lot of earnings, but it's not a unique phenomenon for the index. As you could see over the last 3 years, we have been about the $1 trillion mark from 2014 onwards, and it's expected to move up to 1.3 trillion in 2018. Let's take a look at the final slide. And what we are showing here, you could see that in this slide, the slope of the curve from 14, 15 to 16 is not as flat as it was in the aggregate one. In here, we are looking at the aggregate annual earnings picture on an ex-energy basis. You could see that 2016 is not negative when looked at on an ex-energy basis. It's almost flat, up 0.6%. Could very well turn positive depending on how good the Q4 earnings season turns out. But you could see that in 2017, the growth for the index on an ex-energy basis is expected to be plus 8.7%. So energy is a positive contributor, but there's plenty of positive contribution from other areas as well. The most notable ones that I want to mention briefly is finance and technology. Both of those big sectors that combined account for almost half of the index's total earnings are double-digit earnings growers in 2017. So overall, just stepping back from the numbers and giving my qualitative assessment, I would say that the the broader earnings picture has not been this favorable and positive and encouraging for stock market investors in almost 2 years. So I'm very encouraged and very reassured from what we saw in Q3, from what we saw from management commentary about Q4, and what I see in these numbers.
Okay, Sheraz, yeah. Oh, I'm sorry. Do you have something else?
No, this concludes my my prepared commentary on the Q3 and on the outlook.
Then in that case, let me just follow up with something, and I don't mean to be the doomsayer here, but given the outcome of the presidential election that we saw not long ago, I have to ask, given what we know about this president-elect's stand on trade agreements, energy, does anything at this point concern you that maybe it may act as an interruption to the process of these corporate earnings turning higher?
Yes and no, and that's not a good answer for many folks. But let me explain what I mean by that. About 40+% of the S&P 500 revenues come from abroad, and in the presidential campaign, there was a lot of references to tariffs on companies that partly or totally manufacture their products abroad and then bring them into the U.S. market. United Technologies carrier unit used to be in the headlines for the wrong reasons on the same front, and there's a whole bunch of other S&P 500 members and other corporate entities. So the trade issue is a big source of uncertainty as far as this earnings picture is concerned. Thankfully for us, the expectation is that that will be the opening bid in a negotiation when some or all of these trade deals get opened up, and the actual level on which things will settle down will be a lot market and company friendly and earnings friendly than the headlines that came out of the campaign. But even beyond that, I think in the aggregate, what the new president is bringing to the table is more earnings friendly than the trade uncertainty would suggest. Finance, a far bigger earnings contributor to the index than many of these industrial and material sectors combined, has been really restricted in its earnings power over the last 4 to 5 years, primarily because of the historically low interest rates, because of the new regulatory regimes that were put in place post the 2008 Great Recession. So the expectation that those regulatory strictures would be eased, and the expectation that there will be more domestic spending for infrastructure, for tax cuts, and all of that is pushing interest rates already to levels that should help the net interest margins and other revenues for a number of these banks and other financial institutions. So net, in answer to your question, Terry, the trade issue is a source of uncertainty, and it is a source of uncertainty for stocks as well as for earnings. But in the aggregate, my sense is that when everything is netted out, the policies of the new administration will be earnings friendly.
Okay, thanks, Sheraz. Tim, I know you've been waiting patiently. We will get your initial election impressions on the market. But first, against this earnings backdrop, You say that the Zacks Earnings Certain model portfolio is rolling over. What does that mean, especially when you look to the future?
Yeah, so it's really important to note that at the same time as Sheraz noted that earnings are recovering in general, the earnings certain stocks are rolling over in terms of performance. So, you know, once again, each quarter we do this, I try to keep with the spirit of trying to find issues that, you know, no one's talking about. And whenever we see this sort of rollover in terms of performance in this model portfolio, it's something that we really need to dig into and understand the drivers behind it. Before we get going on this, we need to understand what the Zacks Earnings Certain Proxy is. And for anybody who's not aware, we manage several model portfolios. The Zacks Earnings Certain Proxy is one of them. You can simply type in the symbol ZECPE into your symbol monitor in ZRS and access the portfolio. It's a portfolio of 75 of the most earnings stable stocks out of another model portfolio that I manage. It's called the Zacks Growth Portfolio. I don't want to get into the details of how we actually distill that down. You can request a conference call with myself and your account manager. We can go through this in detail. But the idea behind the Zacks Earnings Certain Proxy is it's been in existence for over 20 years. And its EPS forward 12-month can literally be forecast with 95+% confidence. Has extremely low turnover. It is more or less recession-proof earnings, as you'll see in the next slide, and it has high relative performance. The reason why this is important is because these 75 names in aggregate really represent the core of most equity portfolios in one way or another. These stocks are present in those portfolios. Go ahead and go to the next slide. So what we're going to look at is a price and earnings chart out of ZRS of the Zacks Earnings Certain Proxy, and specifically what we're looking at is a 20-year price and earnings chart. Price being the blue line, trailing 4-quarter operating earnings down there in orange. And I've circled the area of concern, and that's the rollover point. And you'll note as well that there are 4 other rollovers of this magnitude in the last 20 years. Go to the next chart. So the next chart is going to be a 1 to 4 panel chart of the Zacks Earnings Certain forward multiple on a 12-month earnings basis, equity risk premium, the total equity discount rate, and the 10-year Treasury. And I've put a red line in the period that is the anomaly. So from that red line, which is literally the July timeframe of 2016 forward, you'll note that's where the PE multiple began turning, or valuation more or less began collapsing. But even more interesting is to note all of the positive correlations amongst equity risk premium, total equity discount rate, and the 10-year Treasury. And so as we start to peel back the layers of this onion, you'll begin to understand exactly what's going on here. This is not normal behavior. Go ahead, let's go to the next slide. We'll talk about what is normal. So the normal behavior for the relationship between equity risk premium and the 10-year Treasury, and again, there's some caveats here. So the normal credit market conditions and normal ranges of equity risk premium must exist. So that normal behavior is over the long term, and we'll look at this here in just a minute. That equity risk premium is actually able to absorb or offset about 70% of the movement in the 10-year Treasury yield. But in order for that condition to exist, we have to have normal credit market conditions. So the credit quality tranches have to be literally of average levels of volatility, and then those same duration tranches have to be under average levels of volatility as well. When we look at normal equity risk premium levels, they need to be within +1, -1 standard deviation of 20-year trend. We'll look at these here in just a minute as well. So on the next slide, what we're going to do is we're going to look at the 20-year interactive chart of equity risk premium plotted against the 10-year Treasury yield, and then we're going to pull up the beta coefficients. And more or less, this is proof that we're able to more or less offset that 70% movement in the Treasury yield. You can see that the R-squared is statistically significant at 0.71, and it's correlated to actually -0.85, -0.844. So significant inverse correlation there. Next slide. is a 20-year 1 to 4 panel chart. Notice that equity risk premium, which is the second panel, I've got those red lines drawn at the +1 and -1 standard deviation. You'll see that we're a little bit above mean, approaching +1 standard deviation, but we're still well within the normal range. And you can also note there the total equity discount rate moving kind of in conjunction with the 10-year Treasury yield and the equity risk premium. This obviously has huge implications for the total equity discount rate. Keep in mind that the total equity discount rate is the sum of the equity risk premium and the 10-year Treasury yield. So when those two are moving together, we can get some really bizarre behaviors. So let's actually track the correlation of the total equity discount rate and the forward multiple of the Zacks Earnings Certain Proxy. So we can hit the next slide. I think you're there. Yeah, you're there. And what you can see here is that we have some relationship, although with an R-squared less than 0.6, it's really not statistically significant. So if you go to the next slide, we'll start to rein this in a little bit. And you'll see that at the 10-year mark, now we have statistically significant rising inverse correlations correlated at -0.9. And this relationship continues to strengthen once we get out of the Great Recession era. So you can go on to the next slide. So 5-year, we raised that R-squared up to 0.98, correlated at -0.99. This is actually since July 1st. You can see almost a 1-for-1 inverse correlation with R-squared. So we really need to start taking a look at the credit market. Something must have happened in the credit market for there to be such a collapse taking place in the valuation in terms of a forward PE on the Zacks Earnings Certain Proxy. Next slide, Terry. So when we look at the credit market, we look at yield spreads, and we're looking for clues as to what actually caused the rollover in valuation on the Zacks Earnings Certain Proxy. And the interesting thing to note, as the 10-year Treasury yield, you can see that huge hump there from Q2 of 15 all the way to Q1 of 16. The 10-year Treasury was beaten down. The collapse in what we call the high yield space was much more dramatic. And you can see that evidenced by the blue line. So when we actually take a look at the spread between those two, you'll see the impact. You can hit the next slide, Terry, of the high yield market. And you can see that correlates perfectly with the decline that we're seeing in that valuation. So it appears as though the high yield market might be bleeding assets out of the Zacks Earnings Certain Proxy names, but we need to take a little bit deeper dive in that. The real statistical significant point you guys need to look at is that start of the Q3 2016 drop. And we'll look at the next slide and see how that correlates to the actual performance of the Zacks Earnings Certain Proxy. So here, we're just taking an actual look at the percentage change in the Zacks Earnings Certain Proxy since roughly Q4 of 2013. So the relationship was normal until that Q3 2016 point, and the real damage started to occur at the start of Q3 of 2016. So you can see where we had market corrections, even Brexit, normal behavior, the recovery was normal, and then all of a sudden we had another leg down or another rally in the high yield space that literally just took the wind out of the Earnings Certain Proxy, and it really hasn't been able to gain ground since. So the interesting thing to note once we've looked at this performance on the Earnings Certain Proxy side is to say, well, that's interesting. What does this look like relative to S&P 500 performance, which takes us to the next slide. And you can see that the Zacks Earnings Certain Proxy is actually not alone in this phenomenon. If you take a look at the S&P 500, which is the purple line right in the middle there, you can see that it more or less followed this behavior as well, but it's definitely not as pronounced as what we see in the Zacks Earnings Certain Proxy. So keep in mind that the Zacks Earnings Certain Proxy does not contain any of the tilt sector members. So no tilt sectors, meaning no financials, no utilities, no energies, no telecoms. So the energy stocks are not here. Okay, so when we're looking at likely credit market catalysts, we already know that the high yield rally was definitely a trigger. So the next thing we need to look at is what constitutes a large percentage of that high yield space, and to do that we look at WTI crude correlations, and you can see that on the next slide. So here is the red line again, noting that collapse in valuation multiple for the earnings certain proxy. And you can see exactly what happened to that spread collapse. So when we look at the high yield spread relative to the 10-year, you can see the collapse. What triggered that money to be rushing into that high yield space was obviously that recovery in crude oil. Okay. Next slide. And again, since there's no names no energy names in the Zacks Earnings Certain Proxy, the S&P 500 was in effect more or less buoyed by the fact that it was able to be offset slightly by those energy names rising, and the Zacks Earnings Certain Proxies just valuations have more or less been, pounded into the ground. And we can see this on the next slide, where we look at S&P 500 energy composite performance versus the earnings certain proxy and the S&P 500. So you can see that correlation there. The orange line is going to be the S&P 500 energy sector equal weighted composite proxy that we created in ZRS, its performance. And then the green line, you're looking at the S&P 500 growth rate. And then obviously the Zacks Earnings Certain Proxy, again, that does not contain any energy stocks, sitting there very much so suppressed at about negative 6.3. And that's really the gist of my presentation, Terry.
All right, Tim, I just want to now try to factor in the election outcome here with regard to interest rates. And the question would be, does this Trump win give the Fed any excuse to delay that December rate hike that a lot of people are expecting?
An excuse to delay? Absolutely. I mean, there's always an excuse to delay. It seems like with this administration, this has been going on for quite some time. The other side of that argument would be that this could potentially be one of the easiest rate hikes ever for the Fed. And I think Sheraz commented on this as well. As I've shown in some of my slides, and I think Sheraz may have even mentioned this as well, I think the bond market has really already priced in about 70 to 80% of what would be a December rate hike already. I think the challenge going forward for stocks is going to be that the S&P 500 yield is almost at parity with the 10-year Treasury. So, we may start seeing some competition from a fixed income perspective at that point for stocks. So that could be definitely a headwind for stocks going forward, where stocks have always been considered. Not only do you get greater yield than the 10-year, but there's obviously the growth prospect. One of those, at least half of that argument, is now potentially going away.
All right, and meantime, just want to get a quick audience member question in here. Would you be a buyer of dips, at least over the near term, given everything that we've talked about?
I'll go ahead and take that. I would, especially in technology. Ever since the election, the technology space has really been pounded. There's definitely been a rotation out into more of the industrial names. And I would buy the dips. I would buy the dips in the cloud stocks and even some of the larger stocks, like some of the social media names, Facebook and others. It would be a good buying opportunity here. So. All
right. Well, we're bumping up against the clock, as we always find ourselves doing in these calls. So unfortunately, that's all we have time for today. I want to thank our panelists, Sheraz, Mian, and Tim Nyland, and thank you, our attendees, for attending. Now, if you have any questions regarding our services, don't hesitate to email them to zrs@zacks.com. And likewise, if you'd like to receive a copy of either Sheraz or Tim's PowerPoint presentation that was featured in today's call, or both, same email address applies, zrs@zacks.com, or contact your ZRS representative directly. In the meantime, thanks again for joining us. Feedback always welcome, and we'll look forward to the next time we're all together on the call.